Welcome to Capital Considerations. I'm Tony Roth, Chief Investment Officer of M&T Bank and Wilmington Trust. In this episode, I am sharing an excerpt from a webinar we held on May 6th, the first 100 days, the Trump administration's impact on the economy and markets. Wilmington Trust Head of Wealth Management, Lisa Roberts, sat down with me, Chief Economist Luke Tilley, and Chief Investment Strategist Meghan Shue to discuss how markets and the broader economy have responded to the administration's early policy actions, and how evolving expectations continue to shape financial trends here in the U.S. and globally. I hope you find this conversation useful. For more investment content and our Policy in Your Wealth series, providing insights on how new policies are reshaping the financial and planning landscapes, visit wilmingtontrust.com. We'll be back with more episodes of Capital Considerations in the coming weeks. Thank you for listening.
Good afternoon, and thank you for joining today's webinar, The First 100 Days, the Trump Administration's Impact on the Economy and Markets from Wilmington Trust, a member of the M&T Bank family.
Hello and good afternoon. I'm Lisa Roberts, Head of Wilmington Trust Wealth Management. Thank you for joining us today as we take a closer look at the economic and market impacts of the first 100 days of the Trump administration. Over the past few months, we've seen a number of policy shifts that have influenced investor sentiment and market activity. And this afternoon, we're going to review how markets and the broader economy have responded to these initial actions and how evolving expectations are shaping financial trends here in the U.S. as well as globally. And in January of 2025, we launched our capital markets forecast, Investing in a Chutes and Ladders Economy, which outlined key policy areas most likely to influence market dynamics. And today we're going to visit some of those areas, specifically regulation, CapEx tax provisions, fiscal debt and deficits, tariffs, and immigration. So these remain central considerations for understanding how policy may continue to affect economic conditions and markets in the months ahead. And joining me to offer perspective on the current environment and the factors that could shape the path forward are M&T Bank and Chief Economist Tony Roth, as well as Chief Economist Luke Tilley, and Wilmington Trust Chief Investment Strategist Meghan Shue. So as we reflect on this time, it's a good reminder of how quickly markets can move in response to change and why it's so important to stay connected with your advisor. So we're here to help you make sense of it all, adjust where needed, and stay focused on what matters most, which is your long-term goals. So we're going to dive in with Tony, and I said you're a chief economist, but you're a chief investment officer for the bank, so appreciate that. And the first 100 days of President Trump's second administration has, in some ways, flown by, and in other days, it's felt like eternity. And we recognize that there are a lot of policy developments that have occurred thus far, and it's important to point out up front that our discussion today is going to focus only on those issues we deem critical to the direction of our economy and the market. So with that in mind, what are the high-level takeaways on the first 100 days and what's ahead?
Thanks so much, Lisa. It's been pretty busy, hasn't it? I remember the last few jobs that I started, my boss in each case was very specific with me, Lisa, and telling me that their advice was to take the first 100 days and just do a lot of listening, don't do anything, so that people knew that I was really listening and paying attention. And I think that this president has a different approach because he has not let any grass grow under his feet, and he's done a lot. There's been a record number of executive orders by far, I think almost 100 executive orders at this point. And this timeline lays out over that 100 days, Lisa, that we're talking about today, the main policy actions that we've seen. And they transpire on two major axes as it relates to the economy and the markets, as you've said, we're going to really focus on today. And the first is that you can see starting the day of inauguration on the 20th of January, you saw that the administration announced immediately, and they kept their word, that they were going to undertake this policy assessment of an America First trade approach and come back by April 1st with recommendations. And so over that period of time, while they were out working, to the surprise, I think, of many market participants, the administration started to move. They first started with tariffs on car parts, and automobiles, and then steel and aluminum. Actually, it might have been steel and aluminum first, actually, and then the automobiles. Actually, the first was additional tariffs on China, and then they had, of course, after that a big delivery of the assessment with the Rose Garden speech with the reciprocal tariffs. They had the reciprocal tariffs, which were suspended for 90 days. And all of that has created what I would describe as some record volatility in markets where we've seen very big drawdowns in short periods of time. We talked about that in our last webinar, but then also some really big recoveries in the market. And the impact of all of that on the economy has been pretty muted from a hard data standpoint. So we had the employment last week, the employment report, the labor report, and it showed very little change in labor conditions. And that's because of a couple things. One is that the economy is fairly resilient. We came into the year with strong balance sheets in the part of corporate America, record profit margins, and very strong balance sheets in the part of consumers, at least the top three quartiles of consumers. And when we pull that together and we have a shock of the beginning of tariffs, the economy has been resilient, but also the measurement period for that first labor report was the week right after those reciprocal tariffs were announced and then suspended. And that caused, I think, companies to sort of freeze and not actually start to lay people off. I think that the next labor report we're going to get for the month of May, the beginning of June, could be a very different story. So we've arrived at the moment now where we have very weak confidence on the part of consumers, very high expectations for future inflation on the part of consumers, record high inflation expectations, and the hard data could start to deteriorate pretty quickly from here. And so as we think about what's going on in the next 100 days, I think the next 100 days are going to be even more monumental than the first 100 days in that we have a vector of policy direction, but we don't really have a magnitude. And the next 100 days are going to tell us how far we're going to go from a tariff standpoint as these trade deals potentially get announced or don't get announced, how long they take to negotiate, what level of mitigation of these tariffs are reflected in these deals, as well as the picture from a fiscal standpoint and potential tax relief. All that's going to happen in the next 100 days, we believe. And that'll, in turn, really set the direction of the market, I think, over the next year.
Thank you. That's a terrific recap there, Tony, and a little bit of thinking about the 100 days ahead. So in our early April event, you and Meghan and Luke outlined how impactful these tariffs really may be. And yet I'm surprised that our recession odds are only 55%. So would you comment on that?
Yeah. So Lisa, at the beginning of the conversation, you alluded to our capital market forecast, chutes and ladders. And there's no question that tariffs are the longest shoot. But I also think that we are at a moment now where we were a week ago of peak policy negativity. And what I mean by that is we had the full extent of the tariffs on the table in front of us. Although there potentially could be some other tariff actions. Obviously, the president likes to use tariffs as a negotiating lever or tool. But we think we're sort of at that peak policy negativity on tariffs. And as we move forward, we do expect to get some relief for the economy from a number of different sources. And those are the ladders that we talk about in the material. And so the trade deals that we're expecting will hopefully help to shorten the length of that shoot of the tariffs themselves. We're going to have a tax bill. I'm going to talk a little bit more about that later in the conversation, that we think is going to provide some incremental stimulus, not just extend the 2017 tax bill tax provisions that we're all aware of, but actually from that baseline pull back on taxes, particularly for corporations in certain important ways. So that's something that is going to happen. The Fed, as Luke is going to talk about, we believe will probably engage in some additional or some incremental accommodation and stimulus from a monetary standpoint. And we also think that a lot of the regulatory priorities of the administration will start to coalesce and take effect and add some relief to different industries in the country, which could help some deal making and could help with companies being able to potentially, with some of the tax provisions, outlay some important amounts of capital that could help them either invest in manufacturing, research and development, et cetera, to get the economy back moving along again. So right now, the market is almost looking through the possibility of a recession to all those goodies, if you will, that we expect to start to come through in the coming weeks and months. And that's why the recession probability is only 55%. And frankly, that's why the market, in our view, has not pulled back further. So again, that next 100 days is going to be as monumental as the first 100.
Yeah. So what I'm hearing there is we started with some shoots, but the expectation is that we'll get some of these ladders, and therefore why we're saying a 55% chance of a recession. So appreciate the comments there. Meghan, I'm going to move over to you. So we're all very well aware of the volatility in the markets in the first 100 days. And I know the teams remain patient, and we've only made minor tweaks to the portfolio during this time. But what in your view makes this market so difficult to trade?
Yeah, thanks, Lisa, and thanks everybody for joining. I would say, as we all know, it's been a tough start to the year. Here we are showing S&P 500 returns during the first 100 days of prior administrations. And this has been the roughest go that we've had in the last 25 years or so. Of course, we tend to associate, especially around elections, we tend to associate market returns with presidents, and often that is not the case. Usually the economy and the markets are moving on their own cycle. But I do think in this instance, where you can see maybe the beginning of President Trump's second term here, we had some strength focusing on prospects for tax cuts, and then he immediately reverted to the higher and broader than expected tariffs. I do think in many ways, the weakness that we've experienced so far is very much related to those concerns. And this is snapping the chalk line at the end of the first 100 days, which was last week. But of course, we've had a nice string of strong performance from the market. So we are down year to date about 4 to 5%. The next slide will show, just in terms of further dimensioning what we've seen in the markets, what amounts to a pretty stark reversal in momentum compared to the prior few years. We have U.S. assets. You can see the Mag 7, Russell 2000, and S&P 500 down on a year-to-date basis, obviously after several years of very strong performance from U.S. equities. And instead, what we're seeing leading has been international equities. So again, that momentum reversal, I think, is as significant as what we're seeing in the U.S. market. And of course, gold has had a very strong return, up about 26% year to date on a confluence of factors, most notably really some risk-off sentiment and a lot of concern about geopolitical risk. Now, further complicating the market story, again, so I've just depicted that it's a momentum reversal between U.S. and non-U.S., but we've also seen a reversal in terms of leadership within the U.S. market as it relates to tech versus non-tech. And this was a big story over the last few years, making it actually very difficult to outperform the S&P 500 when we saw such strong returns from just a handful of tech-related names. And this year, we've seen some of that enthusiasm wane as it relates to tech. So while there's a lot made today between U.S. and non-U.S., some of that is just simply because within the U.S., we're seeing our crown jewel technology underperform. And that is such a big part of the U.S. market that if you're seeing underperformance there and outperformance in other non-tech sectors, chances are that other parts of the equity market and other regions might be doing better also, because it's tougher for those parts of the market to outperform when technology is doing so well. So, Lisa, to go back to your original question about why it's so hard to trade this market, I think there's the obvious and the not so obvious. And the obvious is really that a lot of the risk and concerns and uncertainty that we're seeing today is of a somewhat exogenous nature, political, man-made, whatever word you want to use, but very difficult to predict and very headline-driven. And so I think for that reason, it's a little bit risky to try to predict where the market's going to go, because it could change with a particular headline or a trade deal or an escalation that could come at any moment.
And then the not so obvious reason why it's difficult to trade today gets at a little bit of what Tony was talking about, which is that we came in to this year with an economy showing very little pockets of excess or bubbles. And in that scenario, we would expect any recession to be short and shallow. And if that's the case, you would expect the market to possibly look through any weakness. And we are in the heart of earnings season right now. We're getting a lot of companies pulling guidance, so they're not able to tell us what they expect from their own company's earnings potential over the next year. And yet, in the rearview mirror, earnings are still coming in pretty strong. So it's a complicated environment. The bottom line is that markets have been very volatile. They're likely to remain volatile. And while we tend to associate volatility with down markets, volatility is two-way, and we can have some very strong up days even in the midst of those pullbacks. And that's pretty much what we've been experiencing. And so for that reason, Lisa, we have been hesitant to make too many trades in portfolios and trying to maintain that patience that Tony talked about.
Thank you for reviewing that. And the charts alone certainly show the volatility in the markets and the other factors that you mentioned, and why it's difficult to trade at these times. So appreciate your comments there. Luke, I'm going to move over to you. And turning to the issue that is most front and center for the economy, which is tariffs. And what's the team's current read on how the economy is holding up in the face of those tariffs?
Yeah, Lisa. So we have seen some of the impacts of tariffs, but they really haven't taken hold yet. First, this is just a refresh from our previous webinar, or anybody watching, clients who receive our materials would know that we had moved to this expectation already mentioned of a mild recession coming this year. But emphasis on the word mild there, annual growth still positive, but getting a couple of negative quarters this year. And we do think that that is coming from the impacts of the tariffs. So this is largely unchanged because we did see some of that weakness show up in the first quarter. So as we think about the first 100 days, really, really impactful how these policies have hit. And we see that on the next slide, because last week we received the GDP data. So this is showing GDP growth for the past 2 years, plus the first quarter of this year. And just such a significant reaction to the tariffs. So this is showing the contributions from different parts of the economy. And obviously that last bar, starkly different from the previous ones. And what we saw in the economy in those first 3 months are what you would probably expect in a reaction when people are seeing the news of the tariffs, and it is stockpiling. That's essentially what we are seeing. A surge in imports there. So that's the orange area, dark orange area that's going down below the axis, because in a mathematical sense, those draw away from the overall GDP numbers, because those are items that are not produced within the United States. So in a mathematical sense, pulling down on GDP. And then what we see is just that surge of imports as the spending sort of turned away from our own domestic products, consumers front loading cars, other goods, trying to purchase a lot of things that are expected to move up in price. We also had a big jump in firms that were going into CapEx, particularly on computers and servers. The figure for the first quarter is just astounding. It was a 60% annualized increase in the amount of software, servers, computers that firms were investing in. Again, trying to get ahead of the tariffs that could be coming later. And then the rest of those imports were essentially put on the shelves, and that's the inventory growth, that dark area on top. And I think what's really important here is that this is not the first 100 days. It's January 20th until March 31st, so not even the first 100 days. And what's really important there is this is all of the activity that happened as consumers were responding to tariffs that were announced in February and March on China, but much lower at that point, Canada, Mexico, and the prospect of tariffs that were going to be announced 2 days after sort of the closing point for this period. So again, this is what this comes together as is that diamond that is a slight decrease in total U.S. output, is a 0.3% decline in U.S. output in the first quarter, as basically our efforts turn towards these imports and stocking up. And what we expect to see as we go forward, and as we described in the previous webinar, is that after consumers have done this loading up and now reacting to the new tariffs and all of the uncertainty, firms reacting to that uncertainty, is a slowdown, and we'll actually get a decline and a larger decline as we get into the second and third quarter as the economy tries to adjust to the new tariff situation. And of course, this is all very much subject to how the tariffs go from here. We do think it would be a decline even if tariffs come down, but we're starting to see those deals. We're starting to see some optimism. But for now, this is the outlook and the outlook of the recession. And we've seen some of those impacts come through in the first quarter, Lisa.
Thank you for that, Luke. And what's our take on the inflation side of things? And when do you think Fed will start to cut rates again? Stagflation, it seems to be a more and more common term that I hear. In fact, I just saw it again on the news. So what's your thoughts on that?
Yeah, it's critical here. And we don't really think that we're going to have a stagflation scenario, which that term is usually associated for me with the late 1970s, early 1980s, where we had incredibly high inflation, but then also the weak economy. And as we described in previous webinar in our written materials, we don't expect that consumers are going to be strong enough to push up prices on services. So we're not going to see, we will see the increased prices on imported goods, but we won't necessarily see that translate to overall inflation because, as we've said previously, consumers will not be in a great position to take on those price increases and then also keep spending on services. And even though the tariffs have not really shown up that much in the data yet, on the next slide, we show that it is starting to show up in some spots. And this is not consumer price data. This is producer price data. And you can get a lot of detail here at different stages of production. And here we're showing intermediate input costs for both the manufacturing and the construction sector. Construction sector not really seeing an acceleration in their input costs yet, but the manufacturing sector really seeing it. You know, you and Tony discussed the tariffs on steel and aluminum that were already in place. All of the imports that are not USMCA compliant from Canada and Mexico would have been feeling this impact. But also what we know from research and what we know from behavior and surveys is that firms will start to push through price increases even before the tariffs hit, with options to claw back if tariffs go down, those kinds of items that go into contracts. And then also the pricing through of those tariffs drives these things higher. So these are manufacturing inputs. These are processed goods are already up through the first 3 months of the year, more than an 8% annualized rate. So that is increasing the cost for manufacturers, and they're really going to have to make a decision of whether they can pass those kind of costs on to the consumer. And I was just saying, I don't know how much of that can go through, or you start seeing it hit their profitability or other decisions that they're going to have to make. So as we see the economy weaken, as we see the some of those price pressures move for manufacturers, but not necessarily through to the consumer, we think that the weakness in the economy will end up dictating the Fed's decisions. And on the next slide, we're showing the most up-to-date expectations for us. If we're calling for a recession, then what that plays through to is the Fed cutting rates. Right now, we have the first cut coming in June. Of course, we'll know a lot more tomorrow after Chair Powell speaks after the end of the FOMC meeting. Very likely could push it out to July, but I don't think that those 7 weeks really change the overall story. What we're going to see is as the economy weakens and the Fed is going to decide that they need to accommodate some. When we get updated Fed projections, I don't think we'll see much change there until they actually start cutting. But futures markets have been up and down. But for the most part this year, they've been moving the direction of more cuts, even though the tariffs would drive up some prices. Generally, the market and the bond market and futures have been taking on that view that the economic weakness is going to end up dominating and canceling out the inflationary impacts of tariffs. And you'll see some cuts. They're not showing, as of when we snap the chalk line here, not showing as many cuts as we expect, but we expect it would move that direction as the economy slows down, Lisa.
Thank you for that. So we're expecting the first cut in June, but we are not expecting stagflation. So appreciate the commentary there. Tony, I'm going to move back to you. So it seems like there's two fronts to this trade war. There's US versus China, and there's US versus everyone else. So dimension for us and scale the trade war with China and how you're thinking about those risks. I've heard you emphasize recently in the media how important the China side of this equation is right now, and where you've described the current status quo as really an effective embargo. So can you explain that more to us?
Yeah, it's a very binary situation, Lisa, in that the rest of the world has relatively low tariffs where we have around, let's call it 10% baseline tariffs. And then there are certain areas where the tariffs may be higher, like automobiles, steel, and aluminum. But for the most part, by and large, trade is continuing to flow across the borders. But in the case of China, where we have 150% average tariffs, with the exception of electronics, which is cell phones, computers, et cetera, where you've seen a lot of stocking up, in fact, in advance of potential for larger tariffs when that exemption comes off, we have 150% average tariff rates. And so 60%, okay, that's 60 of containers that would normally be leaving China are not leaving China to come to the US. And that means that it's effectively an embargo because most of the stuff that we usually import from China is not actually leaving their shores and arriving at the US. Now, when we think about the amount of goods that we import from China, it equals 1.7% of GDP in the US. That's a big number. It's around half $500 billion. And of that $500 billion, about half of it are finished goods. So it's our Nike sneakers that we wear, and it's our socks and other things. It's the plastic trays that when we go out and buy a piece of chicken in the grocery store, the chicken sits on those plastic trays. 95% of them come from China. And if we don't get those, then our food supply is going to be heavily disrupted. But then it's also 50% are components that go into other goods that ultimately get finished and go to market, many of which affect small businesses. And so it's that 1.7% of GDP that we're very focused on. And it's the cessation of that trade that really stands to impact the economy and be existential, particularly for small businesses in America. We're hearing it every day from our clients in the context of being a regional bank and a community bank, very deep into our communities. And we continue to hear that these clients of ours, the small businesses, are not able to order what they need in order for their businesses to deliver what they need to their customers. And so we are very focused right now in understanding where this market's going to go and where the economy is going to go on the situation with China. And so it's great to hear, for example, that we may get some announcements this week, potentially on India, Japan, South Korea, Vietnam. Those are the countries that seem to be at the top of the list. But it's China that matters the most right now, because we need to be able to get these tariffs down, let's say by Memorial Day, the latest, in our view, to a level where we can allow trade to recommence before there's too much damage done on a longer lasting basis. I'm not going to use the word permanent, but on a longer lasting basis to these supply chains. Otherwise, what will happen is we'll go into the summer and consumers will further pull back, businesses will pull back, and we will have that recession probability in the month of June go up to much higher levels if we don't get that abatement. And in fact, even last week, the beginning of the week, which drove part of the recovery we saw in markets, we had the Treasury Secretary saying that the current tariff levels were unsustainable and they would come down in the very near future. So I don't know what his definition of very near future is, but if it's not the month of May, we're going to have, too soon we have a problem. So that's sort of how we think about China. There's much more pressure on dealing with this, not as a final agreement, but as a temporary interim solution so that we can have a conversation with them without damaging the economy too badly while that conversation is occurring.
Thank you for that. So I'm going to stay with you, Tony, so don't go on mute.
Okay.
The Republicans in Congress, they're working on a single budget bill that really attempts to tackle many issues in one. So what are your expectations for that bill in terms of the content, the timing, and the market reaction?
Well, here's what matters most about the bill, Lisa, is that the extension of the 2017 bill will cost the government, will cost us over 10 years, about $3.5 to $3.8 trillion. Now, the House and the Senate are coming in around 5.3 to 5.5 trillion, somewhere in that range. Okay, about $2 trillion higher than what it will cost to extend the 2017 tax bill in allowable additional tax cuts, or total tax cuts, I should say, if in fact they can get $2 trillion of savings cuts. So one way to think about this is the Congress is good with extending the current tax regime for another 10 years. The market is okay with it from the perspective of the bond market. So that has been communicated to the bond market as a framework, and the bond market has not done the Liz Truss moment, has not pushed rates back up to levels that would be punishing to the country. But in order for the administration to get the additional $2 trillion of tax cuts, which could consist in, as you see on the slide here, things like 15% tax rate for domestic manufacturing. So a favored tax status if you manufacture in the U.S. Full expensing, which is to say you can deduct the entire investment in the year of expenditure for any type of investment in new factories in the U.S., things like that. Expanding the SALT tax deduction. Anybody that wants to see a full elimination of the cap on SALT deductions is going to be disappointed. That's not going to happen. It's simply too expensive. But what we're seeing is that if the government can come up with $2 trillion of cost savings, then we can get $2 trillion of additional tax cuts. That's the framework. And to the extent that we don't get those cost savings, either because DOGE doesn't go deep enough, or because we're not cutting into entitlement programs, or whatever it may be, then on a dollar for dollar basis, the ability to bring our tax burden down will also come down. And so what we expect is we will get pretty close to that $2 trillion. You're going to see corporate expensing, some increase of the SALT deduction. I think that there's a good chance that there may not be tax on tips because it's only $100 billion for 10 years, since most people aren't really paying tax on their tips anyway. I don't think you're going to see an exemption of Social Security benefits or overtime, either because it's too expensive or it doesn't really make a lot of sense from a policy standpoint. But you're going to see a significant net decrease in the tax burden for companies and individuals. And that will be passed probably sometime in the next 60 days. And then from there, that will be another one of those supports for the economy and the market that'll counteract the negative impact of tariffs, at least the negative impact in the short term, because as we all know, in the long term, there could be benefits from the tariffs. But there, as the president has said, sometimes you have to have pain to get the gain. So that's sort of the way it's being sequenced.
Great, thank you. So a possible another ladder is what I'm hearing.
That's and potentially a long one, Lisa.
Yeah. I like it. So, Luke, going to move back to you. We've discussed immigration policy as being critical for wage growth, inflation expectations, and labor force growth as well. So can you give us an update on how immigration policy is factoring into your outlook?
So this is obviously something where the president has had an impact, much like he talked about during the campaign. What we're showing here are those border encounters reported by U.S. Customs and Border Control, and they are sharply down as people who would be trying to enter the country are deterred by some of the actions that are taken. We haven't really seen widespread deportations that we talked about, which are obviously legally challenging. They are logistically challenging, but the border encounters being down means that we have less people coming into the country, which does contribute to some of the things that we talked about in the capital markets forecast, that we could have challenges with labor force. But those were really more towards if you had the deportation. It's 8.5 million people who are in the workforce estimated that are here that are illegal or undocumented. The lower encounters at the border and the lower illegal immigration is not having that large of an impact yet on the labor force. One thing that we have seen in the labor market data is that the overall level of churn, the amount of hiring and firing and the turnover has come down dramatically, hitting really historic lows, far different from a couple of years ago when there was 2 open jobs for every unemployed person. You had a lot of that job hopping, if you will. But from that peak in labor market tightness 2.5 years ago to now, we've had a 40% decline in total job openings. And as I was saying, we've had a real decline in the number of people who are voluntarily separating from their job, and the hiring rate is down. So less border encounters as promised, or as intended by President Trump as he was coming in, but we haven't really seen it hit the labor force yet. But of course, we'll be watching that. In the case if deportations were to pick up, or if the labor demand were to pick up. Of course, our expectation is for that recession. We expect some job loss. So this will go towards helping that, right? If you don't have more people coming into the country and they're not looking for those open jobs, it mitigates the amount that the unemployment rate would go up, which we currently estimate would be about a 1% increase in the unemployment rate, typical and similar to previous mild recessions. So that's the update there, Lisa.
Great. Thank you. I think a great update. So appreciate it. Meghan, I'm going to circle back to you. Earlier in the conversation, Luke provided an update on the team's recession probability. So with that being the base case, the question comes up, why are we not more defensively positioned?
Yeah. Well, investors tend to, in my view or my perception of it, investors tend to look at recessions as very binary, either recession, bad for markets, no recession, good for markets. And not only are not all recessions the same, but every single one is different. And in the case of a recession where you don't have a tremendous amount of business and consumer retrenchment, which I think in this case, it could be this scenario where you just get everybody kind of pausing and stopping and waiting to see what happens before sort of re-engaging again, rather than true retrenchment and deleveraging. And we're also in, as I said early on, a situation where we do not see big pockets of excess, whether it's housing or tech stocks as in prior recessions. So if you're looking at a short and shallow recession, and here we're listing all of the prior recessions going back to the early 50s, and you can see that in the case of recessions, which are more shallow in nature, maybe more traditional recessions rather than crises or crashes, you not only get a more modest drawdown, but if you look 4 columns over from the left, you get the market bottoming pretty early on in that recession, and then recovering back to the prior peak in relatively short order. And here, actually, on average, even including some really bad recessions, it is on average about 11 months. So you recover in less than a year. And as we know, most of our clients are with us because they have an investment horizon of longer than a year. So in this case, it may be worth staying fully allocated, recognizing that there could be some periods like we just went through over the past few weeks where we see a drawdown, but a quicker recovery. But not really sort of inducing that negative shift in positioning, because as we all know, getting out of the market might seem, you might get that first call right in terms of selling out when the market's higher, but then you have to make sure that you have the sort of the gut to be buying back in when the market is weaker. And a couple of things that maybe I think were mentioned in passing, but I just want to reemphasize again, is that there is again, this is a tremendous, in terms of the tariff-related uncertainty, a tremendous burden to businesses and consumers potentially, but also some sort of relief or release valves that we might see to, in particular, lower interest rates from the Fed, which would reduce borrowing costs for consumers and businesses, affecting mortgage rates, business loans. That could help to cushion the economy. And again, maybe not enough to save the economy, but the market would be willing to look through that. And then also lower oil prices, which we haven't talked about, but are a support for the consumer when you think about the pass-through effect of lower gasoline prices. Ultimately, it comes down to what's priced. So the next slide is showing where we are in terms of S&P 500 valuations. And you can see on the left, the forward price to earnings ratio has come down. Certainly not to where we typically see in a true recession scenario. I'd expect the price to earnings ratio to bottom somewhere between maybe 16 and 18% in a recession. And so we're not there yet. And then on top of that, again, just maybe a little bit more reason to be cautious and maybe expect some additional volatility, even if we don't expect a sustained drawdown, is on the right, looking at earnings revisions. And so I think the key and the takeaway here is that we have seen companies and analysts not really adjusting down their expectations for earnings. We've really only seen earnings revised down about 3% so far. We're seeing a lot more of companies just pulling guidance because they don't really know what to say, just like we don't, many people don't really know what's going to happen here. But in prior recessions, and here we're only going back the last 4, the average earnings drawdown is closer to 18%. If you go back longer and you include some more modest recessions, it's more like 10 to 15%. In either case, I think there is the potential for more volatility in the market as we sort of sort through what the true impact is on earnings. So while we're kind of digesting all of this and have not made a change to our equity positioning, we are still neutral to equities and neutral to fixed income. I do think it's worth mentioning that within fixed income, we have de-risked a little bit by moving from high yield to investment grade fixed income within municipal bond and taxable portfolios. So a slight upgrading of quality, a slight upgrading in terms of defensive positioning within fixed income, because we see an opportunity there, and realistically some additional defaults that we could see within the below investment grade space.
Terrific. Thank you for breaking that down for us. And you do it in such a nice way that makes it just easily understandable. So let's start with you, Tony. You touched on what the next 100 days look like, but more importantly, tell us about our long-term investment philosophy and how the next 300 days look like.
Look, I think that we have to start with 2 things, Lisa. One is that last year's capital market forecast talked about U.S. exceptionalism, and there's been a lot of conversation in the media around the idea that concept now is out of date, outre. It was, last decade's idea or whatnot, and that's not the case at all in our view. We believe that the U.S. is still by far the most dynamic and resilient economy, and even with these tariffs, which I think have some significant virtue to them in terms of creating fairness and a level playing field from a trading standpoint, and also potentially bringing on some quality jobs onshore from a manufacturing standpoint. The real problem here is the way that the administration, in our view, is going about it, which is too fast, trying to take on the whole world at once, and really sort of crushing the consumer sentiment, if you will. And that's why we may have this recession, but it's not because the ultimate objectives are necessarily bad objectives. Having said that, the economy is resilient. And I think that we have to keep in mind that companies are very adaptive. And we came into this situation again with consumers in good shape and companies in good shape. That's really important. There is not an endogenous problem with our economy. We don't see a big financial crisis or housing crisis or anything of that nature. So that's the first thing. Second thing is that the financial markets, particularly the bond market, is telling us right now that the buyers of U.S. securities and buyers of U.S. treasuries are okay with the fiscal approach that the current Congress is taking, which I've outlined. I won't go through it again. But even if we expand the debt load of the country over 10 years by another couple of trillion on top of the 30 trillion we have almost today, they're saying that that's okay. It's not too much given the overall growth in the economy, and that we can keep bond yields at a reasonable level. And that would mean that if we're right about the recession, that as short-term rates come down, long-term rates could come down a bit, maybe not a lot, but a bit. And we could have some relief for homeowners, mortgages, so on and so forth. And so I think Meghan really laid it out beautifully, as you said, and made it easy to understand that because the recession, given these other ladders, given the resilience of the U.S. economy, even if it happens, it won't be deep, it won't be long in our view, that the market will sort of look through that, probably. We could have another drawdown back to the high 4,000s, but overall, I would expect to see markets trade closer to where they are today for most of the year than back down in the high 4,000s. And that means that while we could have some volatility, we need to stay fully invested, and we need to look for opportunities where we believe that we may be turning an economic corner on either the tariffs because we're getting deals or because the economy is adjusting, et cetera, and it may not be priced back into the markets in order to move back into a larger position on risky assets. And we're not there yet, but that's what we're going to be looking for on a go-forward basis. Now, if we get a scenario on the opposite side of the coin where we think that there is more risk than perhaps the market's appreciating, and that would be the case if we don't get any meaningful de-escalation with China between now and Memorial Day. So we were to get to Memorial Day as an example, and we haven't gotten a de-escalation with China, and the markets are still waiting and they're still trading at these levels. I could see us de-risking at that point, as an example. So a lot of unknowns, Lisa, but the large likelihood is that we will get a de-escalation, we will have a mild recession, and we will have a resilient economy and some ladders that pull us through and get us to a good economy and a good market with more highs, if you will, as we get into next year.
Well, I like that. You sound a bit bullish there, Tony. And I think most importantly that when we think about the outlook there, we're positioned for either scenario, and that puts us in a very good position indeed. So thank you for that. And I think with all three of you, I'm hearing a lot about resiliency and still thinking positive outlook here. Again, looking for more of those ladders down the road than the chutes we saw at the very beginning. So, and as we wrap up, remember that you do not have to navigate these shifts alone, and your advisor is here to help and keep you on track towards your goals. And with that, Tony, Meghan, and Luke, thank you so much for sharing your perspectives as always. And also look for an invitation to our June 10th webinar, where our advanced planning team will discuss the potential impacts of the proposed legislation on your current and future tax planning and what steps you might want to consider now. So thanks again for taking the time for joining us today, and enjoy the rest of your day.
This podcast is for educational purposes only and is not intended as an offer or solicitation for the sale of any financial product or service or recommendation or determination that any investment strategy is suitable for a specific investor. Investors should seek financial advice regarding the suitability of any investment strategy based on the investor's objectives, financial situation, and particular needs. The information on Wilmington Trust's capital considerations with Tony Roth has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. The opinions, estimates, and projections constitute the judgment of Wilmington Trust as of the date of this podcast and are subject to change without notice. The opinions of any guest on the Capital Considerations podcast who are not employed by Wilmington Trust or M&T Bank are their own and do not necessarily represent those of M&T Bank Corporate or any of its affiliates. Wilmington Trust is not authorized to and does not provide legal or tax advice. Our advice and recommendations provided to you is illustrative only and subject to the opinions and advice of your own attorney, tax advisor, or other professional advisor. Diversification does not ensure a profit or guarantee against a loss. There is no assurance that any investment strategy will be successful. Past performance cannot guarantee future results. Investing involves a risk, and you may incur a profit or a loss. Any reference to company names mentioned in the podcast should not be construed as investment advice or investment recommendations of those companies. Third-party trademarks and brands are the property of their respective owners. Third parties referenced herein are independent companies and are not affiliated with M&T Bank or Wilmington Trust. Listing them does not suggest a recommendation or endorsement by Wilmington Trust. Private market investments are only available to investors that meet the U.S. Securities and Exchange Commission's definition of qualified purchaser and accredited investor. Facts and views presented in this report have not been reviewed by and may not reflect information known to professionals in other business areas of Wilmington Trust or M&T Bank, and may provide or seek to provide financial services to entities referred to in this report. M&T Bank and Wilmington Trust have established information barriers between their various business groups. As a result, M&T Bank and Wilmington Trust do not disclose certain client relationships or compensation received from such entities in their reports. Investment products are not insured by the FDIC or any other governmental agency, are not deposits of or other obligations of or guaranteed by Wilmington Trust, M&T Bank, or any other bank or entity, and are subject to risks including a possible loss of the principal amount invested. Wilmington Trust is a registered service mark used in connection with various fiduciary and non-fiduciary services offered by certain subsidiaries of M&T Bank Corporation, including, but not limited to, Manufacturers and Traders Trust Company, M&T Bank, Wilmington Trust Company, WTC, operating in Delaware only, Wilmington Trust N.A., WTNA, Wilmington Trust Investment Advisors, Inc., WTIA, Wilmington Funds Management Corporation, WFMC, Wilmington Trust Asset Management, LLC, WTAM, and Wilmington Trust Investment Management, LLC, WTIM. Such services include trustee, custodial, agency, investment management, and other services. International corporate and institutional services are offered through M&T Bank Corporation's international subsidiaries. Loans, credit cards, retail and business deposits, and other business and personal banking services and products are offered by M&T Bank, member FDIC. Copyright 2025, M&T Bank and its affiliates and subsidiaries. All rights reserved.